Hi everyone, we have just a couple of minutes more as folks are connecting to the webinar. We'll begin just in a minute or two. Thanks. Good morning or good afternoon or even good evening to all of you. I believe we have all time zones represented on this call today. Thank you very much for joining the webinar. Our topic for the next hour is financial health of low and moderate income families and the impact on child well-being and opportunities to innovate. Our discussion is companion to a paper published earlier this month called Leveraging Innovation to Support the Financial Health of Low and Moderate Income Families with Children. And the paper can be found at the link here on the page, bit.ly/LMI-FinHealth. So I would tell you that it does need to be all lowercase in order for the bit.ly.com link to work. We are delighted to have with us Elisa Gutman, one of the lead authors of this paper. And she'll be with us today for a guided discussion of the work of her and her team, followed as well by some Q&A. Elisa is a director here at the Center for Financial Services Innovation. We're also joined by Patrick Kane, program associate with the Annie E. Casey Foundation, who was the funder of this work. My name is John Thompson, also with the Center for Financial Services Innovation, and I'll provide some introduction to the work as well as participate in the Q&A during and at the end of our discussion today. As I mentioned, Elisa and I work at the Center for Financial Services Innovation. We are an authority on consumer financial health. We lead a network of innovators committed to building high-quality consumer products and practices. Our mission is to improve the financial health of Americans, especially underserved Americans, by shaping a robust and innovative financial services marketplace with access to high-quality products and services. We do our work really in four specific ways. We serve as a hub for innovators by fostering a dialogue and collaboration through events, network opportunities, and other working groups. We conduct consumer and market research to contribute to the dialogue around high-quality financial services. We do provide grant funding to nonprofits and seed funding to startup innovators who are looking to bring new ideas to market. And we offer consulting and advice services to financial institutions looking to improve their practices or their products. As I mentioned a moment ago, the work for the report that we are discussing today was funded by the Annie E. Casey Foundation. And I would like to turn it to Patrick, if you'd like to say a few words about the foundation and your support of this work.
Thank you, John, and thank you everyone for participating today on today's webinar. The Annie E. Casey Foundation is devoted to developing a brighter future for millions of children at risk of poor educational, economic, social, and health outcomes. Our work focuses on strengthening families and ensuring access to opportunity because children need both to succeed. For 10 years, we have supported the Center for Financial Services and Innovation's work to identify financial products and services that build financial stability and security for consumers. With its strong relationships with financial service providers and its commitment to meeting the needs of the under and unbanked, CFSI seeds innovations that yield high-quality products for consumers. Some of these products or services were alternative credit reporting, prepaid debit cards, and clear disclosures on those cards. And it is through that work that CFSI has been a valued foundation partner. We were very excited about building off of the work that had been funded by American Express, the Ford Foundation, and MetLife to really allow CFSI to look closer at child well-being because it's so closely tied to family financial stability. We believe that the CFSI's research on the financial health of families with children will increase understanding of the particular financial strengths and challenges that parents face and lead to a wider array of financial products and services that help them manage their day-to-day transactions, save for a rainy day, and hopefully plan for the future. So with that, John, I'll turn it back to you.
Terrific. Thanks, Patrick. As Patrick mentioned, this report was written using some analysis of a data set that we compiled from CFSI's Consumer Financial Health Study, which we'll explain a bit more about here shortly. As Patrick also mentioned, the study was funded by American Express, Ford Foundation, and MetLife Foundation. We are really grateful and excited about this data set in so much as it gives us a foundation to explore both the concept of financial health as well as understand how people are doing. And we think this report is really important additional evidence to that and really gives us an opportunity to dig in and examine how families are doing, especially low-income families with children. We had three very specific objectives with this report, and those are to explore the connection between financial health and child well-being. Secondly, to examine the financial health of low to moderate income families with children, to zero in within the data set and understand how the specific cohort of consumers, of households are doing from the perspective of financial health. And thirdly, to begin to explore how financial products and services can help low and moderate income families with children achieve or improve their financial health. So a broad set of objectives as we jumped in, and we're really excited about what we found and hope that you will be as well. As I mentioned a moment ago, the report leverages our consumer financial health study data set, which was built in the summer of 2014 as a nationally representative survey of just over 7,000 consumers. It was conducted by our partner GfK. It was conducted in a really interesting way, which allowed us to access families that might not traditionally be able to participate in online survey delivery. And we've been able to really build a number of reports and analysis using this data set, including a foundational report that introduced the financial health framework as well as a segmentation model to try to help us group customers by their financial health. In our analysis of the various responses to indicators of financial health, we were able to distribute customers into 7 segments, which roll up into 3 primary tiers: those customers that we would call healthy, those that we would call coping, and those that would call vulnerable. And you can see the percentage distribution. About 43% of Americans roll up into a tier that we call healthy. But if 43% are healthy, then 57% are not. And our coping and vulnerable tiers make up just over 138 million American adults, a dramatically larger number than the 68 million underbanked consumers that we had historically been focusing on, and really helping us understand that improving financial health is about all of us, not just some of us. And in those struggling financial households are also 48 million children living within those households. And these households are the topic of our analysis today. So let's jump to it. I'm going to turn the conversation over to Elisa Gutman to walk us through the analysis.
Thanks, John. And thanks for everyone for making the time to be here today. We will look at the findings in 3 sections. And what I'd like to do is pause at the end of each section to take some of your questions, provided we have time, and so we'll work that in. So please feel free to enter your questions as they occur to you into that tool on the side of your screen, and we'll try to take some of them at the end of each of these sections, because they can be almost standalone, right? So the first section that we'll jump in here is about financial health and child well-being and the connections that we see. Then we'll zoom in on LMI families with children, and then we'll talk about opportunities for financial services providers and the community at large, and some of the innovators tackling those challenges. So this first section really involved us looking both at the data from the CFSI Consumer Financial Health Study, as well as third-party research on parenting and child well-being to see where the connections are. And overall, we found that poor financial health has wide-ranging impacts for children, from educational outcomes to the lessons that they learn in their families at an early age, and then overall well-being. So let's dive into some of that detail. The connection between financial health and stress is really central to our learnings and findings here, and to understanding how and why financial health can impact child well-being. The Consumer Financial Health Study found that lower financial health is associated with higher levels of financial stress. And you see this on the left-hand side. We have the 3 financial health tiers that John just mentioned. And what we find is that the 4 segments that are struggling, in aggregate, 40% of the respondents in those segments said their finances cause them significant stress, compared with only 7% of individuals in the 3 financially healthy segments. Then when we look at the body of third-party research on child well-being, we find that there's much evidence that stress compromises parenting. And we quote a number of these sources in the paper, one of which is this quote you see on the right-hand side of the slide. And I'll also mention the Annie E. Casey Foundation's Kids Count report series, which noted that economic uncertainty also increases stress, which then in turn compromises parenting. So the stress can affect how parents raise their children in ways that impede cognitive development and can contribute to behavioral, social, and emotional problems, as well as challenges with physical health. So the takeaway from both of these sets of data together is that the dynamic whereby parental financial stress can negatively impact child well-being is more likely to be present in households with lower levels of financial health. So one of the things that we explored in the paper that John mentioned, sort of that foundational financial health paper that was published in March, was that financial health is not just about income, although income does play an important role. We saw that behaviors and attitudes were very significant in terms of predicting financial health. And what we see here with these financial health indicators is that we see very similar levels in the different tiers across the income spectrum, right? So when we think about financial stress on the left-hand side, we have roughly the same number of households experience of financial stress in each of these tiers, right? There's some variation, but overall it's rather consistent. And so the data suggests that financially healthy households are spending less mental bandwidth on financial challenges, which then contributes to a lower stress environment for their children and creates that space for parents to focus on parenting rather than focusing on financial challenges. And we have a bit of a vicious cycle here in that financial stress can also limit the ability to improve their financial health because stress and mental exhaustion can hamper financial decision-making. This comes through, again, in a variety of studies, and I'll just mention one from the Association of Psychological Science, where they took volunteers, placed them under stressful conditions, and they found that they were then less likely to accurately assess financial risk and less likely to make rational financial decisions. In the Consumer Financial Health Study, we found evidence of a similar dynamic. So planning ahead for large irregular expenses, maintaining a planned savings habit are two of the key behaviors that characterize financial health. And we found that respondents with high levels of financial stress are less likely to exhibit these behaviors. And you see that on the left-hand side of the slide. They're 26% less likely to plan ahead for large irregular expenses and 67% less likely to have a planned saving habit. So this data then suggests that families with high levels of financial stress may be less likely or less able to adopt the behaviors that could help them then improve their financial health. We also find there's a body of evidence around the lessons that children are learning during their upbringing that can help them develop positive financial habits for the long run, right? The parents' actions in the household are real strong factors here in determining what the child's financial behaviors and attitudes will be. Several of the studies that we cite in the paper have suggested that parents' intentional instruction and activities can have an impact on their children's financial knowledge and behavior. One study found that young adults who were raised in homes where their parents modeled good, responsible financial behavior were then less likely to report making financial missteps, such as abusing credit cards and other missteps. And so those results actually held even when they were controlling for socioeconomic backgrounds. So the behaviors that we're seeing in terms of lack of planning, saving, may then have an impact down the road on their children and put them further at a disadvantage in terms of long-run positive examples. So this diagram really sums up all of this data and depicts the relationship among stress, parenting, financial decision-making, and child well-being. Overall, poor financial health is associated with high levels of financial stress and low levels of planning and saving, which then negatively impact both parenting ability as well as child well-being. So this leads us to posit that improving financial health can lead to better outcomes for children, both in the short term as well as in the long term. And that's because reducing the financial stress frees up mental bandwidth for parenting. Establishing those financially healthy habits and behaviors can positively impact children's financial health later in life and help them build resilience, achieve their goals, and create healthy families of their own. So before we come to the end of this section, it's worth noting that a household's financial health can have an impact on the children, but the data suggests that having children also impacts the family's financial health. So I should put it out there, right? We're aware children bring lots of joy and fulfillment, and I don't want to discount that because this is going to sound a little bit negative perhaps, but there's also the complexity that children in the household bring to a family's financial life, right? At a basic level, having a child increases a family's expenses without a corresponding increase in income. So this puts additional pressure on the family's cash flow and creates an increased opportunity for things like a financial emergency or an unexpected expense like a trip to a doctor. So this can make financial resilience even more important, but also harder to achieve. And so you see the data on the slide here. We see that households with children report more frequent unexpected expenses than those without. We see parents reporting that family responsibilities are a significant source of stress more than non-parents. And we also see households with kids engaging in these key financial health behaviors less than those without. So let me pause here and ask John if we have any questions before we move ahead to really dive into the section on LMI, households with children.
Well, we've got a couple of questions, but I think they're more focused and might be more relevant after the next section, so I think we'll save them for that. Okay?
Okay, perfect. So let's keep going. Let's talk about, we've now talked generally about households with children. Now let's talk about the low to moderate income households with children. And you know, these, we wanted to zoom in here because these households are really balancing a number of challenges, right? There's the challenges associated with having children, right, that we just talked about, and parenting. And then there's the challenges associated with having lower income. And so these households really have that, kind of double whammy effect going on. And before we jump in, I want to just make a methodology note here. So for this analysis, CFSI defined LMI households as those with incomes at or below 200% of the federal poverty line, calculated based upon the size of the household. There's a detailed explanation of this at the end of the paper if you're curious. Occasionally we talk about the moderate income versus low income, and so moderate income is 100% to 200% of the poverty line, while low income is 100% or less. And I should note that that was the definition that we adopted. Some of the other research that we quote may have used slightly different definitions. So just methodology notes there. So as I mentioned, these families, LMI families, are dealing with the challenges of low income as well. And we know that having low income, we know this from other research, is associated with greater amounts of stress, which then further compounds this mental tax on financial decision-making for LMI families with children. An American Psychological Association survey on stress found that members of households with annual incomes less than $50,000 report higher overall stress levels than those living in higher income households. And similarly, in the Consumer Financial Health Study, we find the households with incomes at or below 200% of the federal poverty line, those we defined as LMI, also report higher levels of financial stress, and higher than any of these other groups that we're comparing it to here on these slides. You see 40% of those LMI households with kids agree or strongly agree that their finances cause them significant stress. In addition to low income, these households are also have more difficulty predicting their next month's income. So they have lower income and slightly more income volatility than other groups. And that volatility can make planning ahead and other financially healthy behaviors more challenging. And so when we look at the financial health breakdown then of these different groups, what we see is we have far fewer households amongst LMI families with children in that healthy tier, as you see here from this data. And when we looked at all the indicators that then sort of bubble up to the overall financial health segment, what we found was that LMI households with kids exhibit a lower incidence rate for nearly all of the positive indicators of financial health. In particular, they were less likely to plan ahead for irregular expenses, less likely to have a planned saving habit, and less likely to have a long-term saving horizon. And these were three of the strongest predictors of being in a financially healthy segment. So I want to dive into the savings data in a bit more detail, because savings is such a critical component of financial health and for providing children with greater opportunity over the long run. But we see that finding funds to save and doing the saving can be very challenging for LMI families with children. And you see this here on this breakdown where we looked at savings habits. And you see that 38% of LMI households with kids don't save. And that's compared to 16% amongst their higher income households, higher income peers, both those with children and without. And you see that the majority who are saving in an unplanned way. They say, I save whatever's left over at the end of the month. And so that may be, what actually is getting saved is going to vary over time, with only about 1/5 of them saying they save regularly with a plan. So correspondingly then, when we look at the actual amounts saved, we see that compared with their higher income counterparts, LMI families with kids have lower levels of accumulated savings, both in retirement accounts as well as in non-retirement accounts. So now let's look at some of the financial product and service use among LMI families with children. We see that they are less likely to currently have and to have ever had various traditional financial products, such as checking accounts and savings accounts, and they're more likely to use check cashing and payday loans. So this raises questions about whether families have access to products they need to build assets and improve their financial health. And it also raises questions about the children in those households and how they're being socialized and the lessons that they're learning about the costs and benefits of various financial products and services. So when we dive into some of the data on this slide, we see that a little over a fifth of LMI households with kids have neither a checking account nor a savings account. So this is the definition, the sort of traditional definition of being unbanked. So that's significantly higher than the overall percentage for the U.S., which is 7%. We also see that very high percentages of families with children, LMI families with children, who currently say they don't have a checking account or a savings account, have never had one. So this is interesting because it's sort of this potentially a pattern, right? They don't have these accounts and they haven't had one before. They've really not had experience with these types of accounts. And then we see only half of LMI families with kids have a credit card. And this is a much lower rate of ownership than the general population. The number for the total U.S. is 75%, and you see it's even higher for non-LMI households with kids. They're at an 83% ownership rate for credit cards. So you can think about what that might mean for liquidity in an environment where you have unexpected expenses and income volatility. And then the final slide in this section is about digital financial product and service use. So given that LMI households with kids have lower rates of ownership of checking and savings accounts, it's probably not surprising that overall they have a lower rate of using internet banking and mobile banking. But when we hone in on those who have those products, the LMI households with kids that have a checking account, what we see is that their use of mobile banking is actually greater than that of the U.S. population, the general U.S. population that has a checking account, right? So 35% of LMI households with kids who have a checking account said they used mobile banking in the last 30 days as compared to 30% of just the general U.S. population. And that goes up even higher when we look at the moderate income group. So this brings us to the end of the section on LMI families with children. And so I'll pause here and, John, come back to you and see, or we want to address any of those questions that were asked before. Were there any new questions that came in that we ought to address here?
There's one question that we've got that I think might be interesting for you to comment on. Is I'll see if I can frame this in the way that the requester asked for it. But is there something that's going on with respect to the age of the households that is driving some of the indicators of what you talked about before in terms of not owning banking accounts or perhaps the use of mobile banking? Is there an effect of age that we've been able to detect? And did we explore that in the report?
That's interesting. So in the analysis where we said, households are more likely to or less likely to, we controlled for various variables like age. I think overall what we see is households with kids, they're tending to trend lower on the age spectrum because they are of childbearing age. They still have children at home, and so overall we saw these households trending younger. But there wasn't anything else that stands up that's sort of top of mind for me about the impact of age here.
Okay, excellent. I think we have another sort of tactical request around, could you define mobile banking as opposed to internet banking in the way that it manifests itself in the data?
Sure. So in the survey, we defined internet banking and mobile banking. So mobile banking would have been, pulling up your bank's either mobile app or mobile website on your mobile device, versus internet banking would have been accessing your bank site on a PC, on a computer, rather than on a mobile device. Does that answer the question?
All right. I think it does, but we've got a couple of other questions that are sort of pointing around the edges of that same topic, which I wonder if you might be able to explore. Specifically about, did we take an examination of these households and use the lens of availability of internet service at home? And then I think another question along those lines is really, do we think that the mobile usage versus internet usage is driven by sort of a difference in availability of mobile device versus what we might traditionally call landline internet access at home? So a few questions on that topic.
Sure. So our survey provider is the GfK is the name of the survey provider that we collaborated with to gather this data. And the interesting thing about them is that they use census data to go out and recruit people to be part of their panel so that they can recruit a representative sample. And when somebody responds and says, yes, I want to be a part of your panel, but they don't have internet access at home, they actually provide them with internet service and a netbook so that they can take these surveys at home. So everybody who took the survey had internet access at home, although we would be able to look at the data and tell who sort of had it before or who had it provided by the survey vendor. Offhand, I don't know what the results would be there for this group. I think, and in terms of the mobile access, the mobile availability of the mobile device, there's national data showing that while smartphone ownership amongst lower income groups is lower, for those lower income households who have smartphones, they tend to use mobile financial services more than their higher income counterparts. So I think this data is in line with some of that national data that's out there. I'm specifically thinking about the mobile and internet report that the Federal Reserve puts out. So I think it's in line with that.
Terrific. There's a variety of questions around this topic that I think might be useful for some additional exploration. So great questions. Keep them coming. I think there's one more that we've got a couple of questions about that would be useful to sort of answer here. Could you talk a little bit about the control for, or what controls might have been in place for geography? Specifically, a couple of the questions zero in on rural versus urban, and the corresponding access to banking, retail banking services as a principal driver of, or how it might impact some of the data that we've seen in the last couple of slides.
Yeah, that's interesting. So we didn't look specifically at regional differences, right? It was a national survey, and so we looked at the group nationally. I think, actually, at the end of the report, there's an appendix with a table that includes some of the demographic breakdowns, and it compares the within the Consumer Financial Health Study to census data for households, LMI households with children. And so actually, I was just thinking about that in terms of the age question. You'll see some of the variation there on age. But then also regionally, you'll see how our regional distribution compared with that of the census. About a very significant portion, so about 44% of the Consumer Financial Health Study LMI Families with Kids group was located in the South. So that was the largest group. And that in the census data, that is also the largest group, although it's slightly smaller. And so we see that sort of regional skew in the data set about where LMI families with children are located, right? Heavily concentrated in the South, that 44% is the biggest group, and the smallest group, 12%, is in the Northeast. So that's from a regional perspective. I don't have the sort of urban versus rural data on hand, but we can certainly look at that and follow up.
Yeah, I think we've got a rich set of questions about some ways to sort of extend the research into smaller pockets, which might provide some useful information for some of the folks on the call. So we'll save some of that as follow-up as well. Got a bunch of questions, but I think a number of them will either be discussed in the next section, so I'd like to go ahead and let you move forward.
All right, let's do that. Okay, so the last section here is around the opportunity. And we think that improving family financial health represents a really rich but often overlooked opportunity to enhance child well-being in America. And so when we think about what that is, right, there's both this need, a clear need amongst LMI families with children, but then also this opportunity for the financial services community at large. And that would include financial institutions, nonprofit organizations, financial technology companies, as well as policymakers, to play a role in promoting family success with programs, services, and high-quality products that improve financial health for the entire family. And as you think about where to start, right, we are proposing starting by focusing on those areas where we see these primary challenges amongst LMI families, right? So stress and decision-making. The opportunity here is to think about, are there products and services that can help families make good financial decisions even though they are dealing with a lot of stress? So could we create the types of products that help them overcome the sort of impediments that the stress is putting in their way? Then second, we talk about saving. So establishing and maintaining savings habits in the short term and the long term can be really important for these families to provide emergency funds when there are unexpected expenses, helping them really plan and save for some of these longer term opportunities, and really thinking innovatively about how can we do this when some of the more traditional models may not work for these families. And then finally, setting an example. So what are some products and services, ways to really help familiarize children with high quality products and services and good financial habits and some of the research on these programs that we'll talk about shows that not only benefits the children, but then has sort of a trickle-up effect where it then benefits parents and the families at large by stimulating some of that dialogue at home. So we'll start with the first category, stress and decision-making, and we'll highlight a handful of innovators who are doing really interesting work in this area. So starting on the left, we have KeyBank and Hello Wallet, and they have partnered to provide KeyBank's customers with Hello Wallet's financial wellness score. And that provides an assessment of their overall financial health and then serves as the basis for personalized financial guidance that can be made available for customers. Next, we have Simple, which you may be familiar with. They were acquired by BBVA. They're sometimes called a neobank or an online banking platform. And they have a feature called the Safe to Spend balance that they provide to their customers. And that's calculated by subtracting pending transactions, upcoming bill payment amounts, and planned savings contributions from their actual account balance. So when they display the Safe to Spend balance, it actually reduces the need for the customer, him or herself, to do that mental math on their own or on the fly before they decide whether they should make a transaction or not. So it helps them sort of paint this more realistic picture of what is available for them to spend at that moment, given all these other things that they have going on in their lives. Next, we'll talk about Prism. So Prism is a financial technology company that is actually a member of CFSI's Financial Solutions Lab cohort, our first cohort. And they offer a bill payment platform that presents all of the user's bills in one place. And that enables customers to easily sequence their bills and align them with household cash flows in a way that they can then manage a variety of financial obligations within that single platform, so to help sort of streamline and simplify. And then our last two, Support Pay and Better Have. These two fintech companies are really focusing on helping to reduce the stress and mental bandwidth required to manage family expenses. So I'll start with Better Have. They've created a financial management app that's designed to help couples manage a joint budget, track shared and individual expenses, and then set aside money for mutual savings goals. Support Pay, which is also a member of our Financial Solutions Lab cohort, they offer a financial management and payment platform that's designed for helping separated and divorced couples easily manage shared childcare expenses. So they're really focused on allowing parents to devote more time and attention to raising their children instead of being distracted and spending a lot of energy and stress around dealing with each other and dealing with the finances. So now we'll move on to saving. And what we're looking at here is the top 3 reasons that families save. And I think what this underscores is that reasons for saving are diverse. The families that we're talking about are not a homogeneous group. They have different reasons for saving at different times and varying capacities to save at different times. And we know that they're grappling with tight financial cushions, frequent unexpected expenses, and volatile incomes, all of which can make sort of the standard budgeted approach to saving really difficult or perhaps impractical or just unattractive for them. So there's a real opportunity here to innovate and test creative approaches to saving that might better fit the contours of these families' lives. And so we'll look at a variety of different types of innovation in saving. We'll start with transaction-based saving. And these tools facilitate small saving contributions that are made automatically whenever an individual makes a transaction. So for families where finding room in the budget for sort of planned or scheduled saving may be difficult, this might be an alternative to sort of a way to make small, steady deposits over time. And 3 examples of this. So Bank of America's Keep the Change program was created in 2005. And for each participant enrolled in the program, every time they make a transaction on their debit card, the transaction amount is rounded up to the nearest dollar, and the difference is then transferred into their savings account. And so this program's been around 10 years, and since that, the participants have saved over $8 billion. So there's a lot of potential here to really help people save. Wells Fargo's Way to Save program is similar. They have a variety of automatic savings options that consumers can customize, and they can tie them to transactions, or they can tie them to specific cadences, for example, making a monthly savings deposit. And then Saved Plus has built a tool that allows anyone to set up this kind of transaction-based saving capability on top of any savings account. And they have a number of savings options as well. Next, we'll talk about automatic or smart transfers. Digit is another startup in CFSI's Financial Solutions Lab that uses an intelligent algorithm to mine customers' transaction account activity. So looking at all the activity in a checking account, for example, and determining where there are small amounts of money that appear to be available for saving. Then they automatically transfer those amounts from the transaction account to an FDIC-insured Digit account on the user's behalf. And they're so confident in the capabilities of these algorithms that should the consumer overdraft because of one of these automatic sweeps, they will actually reimburse those overdraft fees. They also send on regular cadences, I believe it's weekly, they send text messages that summarize for consumers how much they save to sort of reinforce and encourage that behavior. And now we come to prize-linked savings, which you may be familiar with, but the idea here is to present savers with the opportunity to win a prize each time they make a deposit. So this really provides like a no-lose game of chance for consumers, right? And it helps incentivize building the saving habit. Doorways to Dreams, or D2D, pioneered the approach in the U.S. with a pilot that was conducted at Michigan credit unions. And it offered members the chance to win a variety of small prizes and one large prize every time they deposited $25 into their savings account. The program was called Save to Win, and it's now available at over 60 credit unions in 6 states. And since 2009, the participants have collectively saved $115 million. And the interesting thing is that the majority of those participants actually came from financially vulnerable households. So it's really, these pilots have really proven the viability of this approach. And the adoption is really increasing. And we saw that the American Savings Promotion Act was signed into federal law in 2014, which opened a pathway for banks and credit unions to offer similar programs. D2D then adapted this idea and built on the prize-linked savings model to encourage savings at tax time, right, which is a really key moment, particularly amongst LMI families with children who are receiving EITC credits. And so these sorry. I wanted to make sure to get the name of this program. This is the Save Your Refund program. That's D2D's innovation here to help adult tax filers who use Form 8888 save a portion of their federal tax refund and win cash prizes. So we'll move on to children's savings accounts. And this is actually a nice bridge between the savings section and the next section on providing positive early examples for children. A great example of children's savings accounts is the Kindergarten to College program, which is an initiative in San Francisco, wherein every child who enrolls in the public schools has a savings account, college savings account open for them, and there's a $50 deposit from the city made for them. For those in the school lunch program, an additional $50 deposit. And there's various incentives along the way to incentivize savings. And so this is a great example of really helping families think longer term, extending their savings horizons. There was a 2013 study which found that children in LMI families that have some college savings are more likely to attend and graduate from college than children without. And so this program is a really great example of helping to further that savings horizon and the planning, helping families think about how to save for long term and also achieve mobility via education. So I know we're running short on time. This is the last slide on innovators, and so we won't go through all of these in detail because I want to make sure we have a little bit of time for any remaining questions. But these are great examples of innovators who are thinking about how do we help young people, youth, early on think about how to manage their money, learn about high-quality products, and in the example of Bank at School, also parents frequently get engaged as well. So I'll pause here, and we'll just end with this quote from Annie E. Casey's Kids Count report about really the importance of supporting parents in order to help kids. And I'll turn it back over to you, John. If there are any pressing questions, happy to answer those. I would also love for your comments around the opportunity you and Patrick see about helping the financial services community really apply this information and how we take this sort of from theoretical to application.
Sure, that's a great question. I think I'll take that and then let Patrick address it. And then we have just a huge set of questions, which is awesome. We're not going to be able to cover them all on this call, but there's some great follow-up and maybe suggestions for areas to explore further. I think this report, as a as someone who works with providers every day, product suppliers every day, really shines, I think, an important and sometimes really sort of painful view on households in a way that I don't think is really obvious to providers, right? Generally, they're thinking of the customer more in terms of the adult and the adult's finances and not thinking about the consequential impacts, of the products that are out there in the marketplace. And I think, it really shows me thinking about the long-term financial models that that financial services providers need to be thinking about. The impact that products have on consumer outcomes, right? That investing in improving the financial health of consumers could actually likely drive, generational impacts in the way that their business models work. So I think in some ways I'm really excited about being able to take this learning and share it with providers who don't have a lens into some of these, to the household as much as the, sort of individual provider, the parent, the single parent they might have a relationship with. Patrick, any thoughts really from your end before we jump into questions?
John, I would definitely agree with that. Thinking about this multi-generational opportunity from service providers. Additionally, I'm curious if there's something that potentially the federal government could help facilitate to that end, right? I don't know what that would look like yet, but that's something that would be interesting to help facilitate that that movement and thought, right?
Mm-hmm. Aliza, I'm trying to assemble this into a question that's representative of multiple questions on this topic, but we've got a number of questions about the sort of barrier that low and moderate income families have to pass through from an identity standpoint, from an identity verification standpoint, is potentially a barrier to access for products. Do we have kind of a sense in the data set about the difficulty that families face at connecting to products just based on identity, and or the concerns that they may have about the risk of engaging in the financial services sector due to identity theft and other issues like that.
Interesting. So that last part where you said identity theft, I thought you were getting at sort of the requirements to present documentation at account opening.
Yeah, I'm blending a couple of questions, right? Both about what you said, as well as, I think a couple of participants in the call have really noted that perhaps there's some work that practitioners should be doing with families to help overcome concerns about identity theft and privacy, specifically surrounding internet and mobile banking. So really a couple of questions conflated into one general direction.
Yeah. Yeah, I think so. I think we have items in the data that kind of get around the edges of this, perhaps not directly, but when we ask consumers about, why don't you have a checking account similar to the FDIC, we find that there's a portion who don't trust. There's a mistrust issue. I'm speaking generally about the results, not necessarily looking at it just with the lens of this population, because I don't have the data right in front of me for that population. But generally, we find trust, fees, and then some of the documentation kind of comes in the answers about, I don't think I would, have the right. I don't think I can open the account, right? And there may be many reasons for that. Either I don't have the right documentation, or I think, I don't have credit and maybe my credit score will impact. So there's definitely, we see trust and sometimes a lack of understanding of what it actually would take to open an account can be barriers. And so I think there's an opportunity there, particularly a lot of our nonprofit partners we see doing work to really help families understand what some of those eligibility and security requirements or assurances are.
Excellent, thank you. I'm just going to note, we don't have time to ask and answer these questions, but I want to note just for the respondents sort of some of the thematic questions that have come through that might be helpful. We've got a cohort of questions around whether we think the innovations around automated savings actually make it more difficult for consumers to manage their financial lives because it spreads out account data into different places and is more difficult to reconcile. So I think that's an area that we've gotten a number of questions about. We've got a couple of questions about whether the report breaks the data down, not just by geography, but also by race or other sort of factors. So I think there's some questions about perhaps slicing the data and publishing that information. So we may want to follow up on some of that question. And then I think there's a series of questions that wonder about the exploration of cost, right? Have we really looked at total cost of ownership that consumers are facing when they access this? So I don't know if you want to take 15 seconds on comment on any of that before we wrap up.
Just quickly, I will say the race question, so that table at the end of the paper that I mentioned has breakdown by race, so you can see that there. And the cost question, that was not part of this, but it's a really, really good question.
Awesome. Well, there are a number of questions that we didn't get a chance to answer, and we'll follow those back up individually. And know that, as we mentioned, this is based on a data set that's open that we can do analysis on. So there's, if you have specific questions you'd like us to explore, please don't hesitate to reach out to any of us here at CFSI. Thank you very much for your time and your attention, for your fantastic questions. We think this is an incredibly important piece of work in the field that helps connect some dots between work around kids and families and work around financial products and services. An area that needs to be explored more deeply and acted against by our industry. Best wishes and enjoy the afternoon. Thanks.